So for taxpayers that are either individuals or businesses that have either paid or accrued taxes to a foreign country or a U.S. possession and are subject to U.S. tax on the same income, they may be able to take either of those, they may either be able to take a foreign tax credit or a foreign tax deduction. It's important that we're talking about that they have incurred U.S. income tax on the amount of tax they've paid foreign tax to, or the amount of income they've paid foreign tax on. One of the main questions that I get is for taxpayers that are living outside of the United States and they've paid foreign tax on the income, and the income was earned specifically, let's say for COVID. So you have a German employer, you were living and working in Germany, and you paid all this German tax because it comes out of your paycheck, just like it would if you were in the US. But because of COVID, you had to relocate to the United States. That income is subject to US tax because it's not about who pays you, it's about where you physically are earning the income. So if you're a person, if you're physically sitting in the US, that's US source income, even though you paid German tax on it already. So I've seen a lot of confusion, I'll say, for taxpayers that have paid foreign tax on income that's now subject to US tax on it, but they don't understand why they can't get a foreign tax credit on that portion of the income versus the income that they earned when they were physically sitting overseas. So when we start talking later about sourcing of income, that's why that's important. Determining whether the income, even if it's foreign paid, is foreign sourced, because that's going to impact whether or not you get to take a foreign tax credit. Now, the foreign tax deduction is a little less stringent because it just looks at how much foreign tax did you pay. Yes, you can take a deduction, and we're going to talk about that as well. For foreign countries, now this is different. Normally, so in my space, I deal with a lot of international taxpayers. And normally when we're talking about a foreign country, we're talking about anything within the continental United States. We're talking about anything other than the sovereignty of the US government, which includes possessions. For foreign tax credit purposes, the possessions are treated as foreign. So if I was looking at anything else for Puerto Rico in particular, Puerto Rico is 99% of the time it's deemed US. So if you're living and working in Puerto Rico, you're on US soil and things like that. But for foreign tax credit purposes, when we start talking about the US possessions, they are treated as foreign. So Puerto Rico, US Virgin Islands, Guam, Northern Mariana Islands, and American Samoa, those are all treated as foreign for foreign tax credit purposes, but they may be treated as US for other purposes. So I just wanted to call that out here. The foreign tax credit is reported on Form 1116 for individuals and 1118 for corporations. If you are doing a foreign tax credit calculation for an estate or a trust, that will be reported on the individual foreign tax credit form, the 1116. The foreign tax deduction